One thing you mentioned that was interesting, or at least stood out to me, is you talk about each person's situation is unique, and one of the things that's unique about each person's situation is their income to debt ratio. What part does that play in someone who's, looking to get a loan? When, let's say, they're buying their first home.
Sometimes loan officers kind of go off script and they'll drop the lingo in the business, and someone goes, DTI is what we call it. I'm like,
Right.
what are you talking about? Oh, I'm sorry. Let me go back and explain. The debt to income ratio is your total debt. So that adds like credit card minimum payments, which a lot of people don't realize. We do it based on the minimum payment, not the full payment. Maybe you have student debt, but it's deferred. If the student debt's deferred, I don't necessarily have to count it. That's definitely like the first thing a loan officer might ask. If they say, oh, your debt to income ratio is high, and there's technically a limit of 43%, but there's some leeway there depending on how good other parts of your loan are. So the loan compared to the sales price is low. So they'll give you more leeway on the debt to income ratio. Or maybe you have a lot of reserves, a lot of cash on hand in your bank.
Okay.
We can be a little bit more risky, so to speak,
Okay.
because really this is all risk assessment.
Yeah.
We're assessing if the risk of giving you a loan is safe. So it's not personal, it's all numbers.
Yeah.
So when we ask for stuff about the process, it's all about that. And so your debt to income ratio, it can affect your rate sometimes, not too much, maybe a little bit, maybe like an 8.
Okay.
If it's high. So if you have a debt to income ratio that's higher than
Gotcha.
43%, maybe we can keep you in a conforming loan, the normal loan.
Yeah.
Or maybe we have to go over to FHA or government loan, VA.
Okay.
They have higher percents that are allowed. I'm not someone who likes seeing that for my clients. If I can get them into a conforming loan, I'd prefer that. But also to get you into that mortgage, you're doing 50% of your gross pay compared to the debt you have. So you actually take your taxes out and your net pay. The debt to income ratio can be more like 66%. So it can be pretty risky when you kind of force yourself into buying a house at that high of a ratio, only because if you have a time like this where you happen to lose your job, just because you forced yourself into a house, now all of a sudden the savings you had for a long period of time, they're gone a lot faster. Anytime a loan officer can get you into a smaller house, a smaller loan, so that it's a good loan for you, they're doing you a favor. It's not about trying to stop you from getting the house you want. It's about making sure it's a good financial decision as well.
Right.